The PE tells you how expensive a stock is relative to earnings. Revenue tells you how big the business is. Market cap tells you what the market thinks it's worth today. None of those tell you whether this business is actually worth owning for the next 10 years. There are 6 dimensions that do, and the gap between them on 2 real companies in the exact same sector is one of the most telling things I've seen in a while. One scores 7.9 out of 10 on business quality. The other scores 2.9. Same exchange, same industry classification, but completely different stories underneath. And here's the question worth sitting with. Does a higher quality score automatically mean a better investment? The answer isn't what most people expect. This is Invyra's IQ score, a composite signal built from 6 dimensions of business quality, weighted and aggregated into a single number from 0 to 10. It's directional, not a price forecast. It's not telling you this stock will go up. It's telling you, based on the evidence in the financial statements right now, how strong is the underlying business. Each dimension is scored independently. The scores are normalized relative to the broader market. So 7.9 doesn't mean NVIDIA is perfect. It means NVIDIA is in the strong cohort. 2.9 means Intel is in the weak cohort by the same standard. Now let me show you what each dimension actually measures, and why this comparison is one of the clearest illustrations of how business quality and investment thesis can diverge completely. Most investors analyze a stock with 2 or 3 numbers: PE, revenue growth, maybe market cap. These are useful, but they answer a narrow set of questions. What they don't capture, whether the business has a durable competitive advantage, whether it's earning enough on invested capital to justify reinvestment, whether the balance sheet can absorb a downturn. The most dangerous version of this mistake, buying a business with recognizable revenue growth while ignoring that it's earning less than what capital costs to run it. That business destroys value every quarter, even as the top line looks fine. We're going to see exactly that pattern in a few minutes. The 6 dimensions of Invyra IQ: clarity, earnings, predictability, efficiency, how well the business converts invested capital into returns. Growth only creates value when ROIC exceeds cost of capital. Durability, competitive moat, momentum, business trajectory, improving or deteriorating. Resilience, balance sheet health, opportunity, valuation upside relative to estimated intrinsic value. Let's run both companies. NVIDIA, IQ, 7.9 out of 10. Durability, 10.0. Maximum score. The moat isn't just the GPU hardware. It's the shootist software ecosystem that enterprises, research labs, and AI developers have built years of workflows on top of. Switching away from NVIDIA isn't a product decision, it's an infrastructure rebuild. That's a different category of moat than brand loyalty. Efficiency, 9.6, reported ROIC, approximately 70% against an estimated WACC of 15.5% under Invyra's methodology. That's spread between what the business earns on capital and what capital costs to raise. That's what drives long-term compounding. Momentum, 9.2. FY20, 26 revenue, $215.94 billion, up 65.5% YOY. Net income, $120.07 billion. Free cash flow, $96.68 billion. Net margin, 55.6%. Every trajectory metric is accelerating. Resilience, 8.4. Financial health, 4 out of 4. Current ratio, 3.91. Debt over EBITDA at 0.08. Effectively debt-free relative to earnings power. The balance sheet provides significant flexibility. Now, you might expect NVIDIA to score near perfect across all 6 dimensions. It doesn't. Clarity, 3.7. The lowest score in the profile. When revenue is growing at 65% annually, earnings predictability is genuinely hard to model. The trajectory is extraordinary, but consistency over time, which clarity requires, is difficult to establish at this velocity. IQ captures that honestly. Opportunity, 5.9. Current market price, $224.18 against a fair value estimate of $261.60, a 14.3% discount. The upside is real, but the multiple already embeds a significant portion of the growth story. A 5.9 isn't a warning. It means the gap is there, just not deep value. Overall, 7.9. Strength across most dimensions, with one honest caveat on predictability. Intel, IQ 2.9 out of 10. Quick note, NVIDIA and Intel share a sector classification, but not an identical business model. NVIDIA is a fabless chip designer. Intel designs CPUs and is midway through a large foundry investment. The comparison is useful, but not perfectly like for like. Durability? 2.8, narrow moat. Intel still has competitive advantages, but they require ongoing capital investment to maintain, and the architectural lead it held for decades has narrowed significantly. Efficiency, 1.4, the critical number. Under Invyra's methodology, reported ROIC is approximately 0% against an estimated WACC of 11.8%. The business is not currently covering its cost of capital. Revenue, $52.85 billion, down 0.5%. Net income, negative $267 million. Free cash flow, negative $4.95 billion. Gross margin, 34.8% versus NVIDIA's 71.1%. Momentum, 4.3. Revenue, flat to declining. No recovery visible in the current data yet. Resilience, 5.3. Current ratio, 2.02. The only health check Intel passes. Debt over EBITDA, at 3.2. 5 exceeds the target of below 3. Invyra's debt servicing metric reads 4,743% against a target of below 0.4%, reflecting elevated debt load against negative free cash flow. Real balance sheet pressure, though not acute liquidity risk, opportunity 1.9. Invyra's composite fair value estimate, $28.74 against a current price of $100.95, a 251% premium under current data. Important framing. This estimate reflects the business as it exists today, not a turnaround scenario. If Intel's foundry strategy executes successfully, the inputs change significantly. Overall, 2.9. Fundamental weaknesses across most dimensions in the current period. Here's the part that ties everything together. Intel's SMI on Invyra is institutional and insider activity signal, reads plus 30, bullish. That signal carries a reporting lag, but the directional read is accumulation, not distribution. And Intel stock has moved substantially over the past year, from the low 20s to over $100. Institutions are not running away. So, how do you hold IQ, how 2.9, and bullish SMI at the same time? They're answering different questions. IQ is asking, based on today's data, is this business worth owning? The institutional thesis is asking, if the turnaround works, is there a return here? Both are legitimate, but they are not the same question. IQ tells you what you know. The turnaround thesis asks you to bet on what you don't yet have evidence for. IQ is a compass, not a catalyst. A high score doesn't guarantee the stock goes up next quarter. A 2.9 business with a compelling narrative can outperform a 7.9 business in the short term. The Intel example shows that clearly. What IQ tells you, if I own this for 5 to 10 years, are the underlying fundamentals working for me or against me? For NVIDIA, at 7.9, largely yes. Elite efficiency, entrenched mode, strong trajectory. The risks are predictability at this growth rate and how much is already priced in, but they're risks inside a functioning machine. For Intel at 2.9, not yet. Negative R, OIC, negative free cash flow, a narrowing moat, and a price that appears to embed a recovery that hasn't shown up in the data. Turnarounds do happen, but right now you're buying what Intel might become, not what it is. The question I ask before looking at price, is the underlying machine already functioning? If yes, time is on my side. If no, I'm speculating on transformation. Both can be valid trades, but they are not the same thing. If this gave you a useful framework for separating business quality from investment thesis, like, subscribe, and share it with someone who still reads a stock's health through PE alone. And why it changes what these IQ scores actually mean. Invyra is linked in this description.